Yeah, I've got some unexpected awesome stuff. I'm sure Cairo's gonna hit us with some amazing stuff as well. Let's give him a welcome with this one. Let's do this one.
Sometimes you just gotta shut the FUD up.
Boom. You know how long it took me to get that chicken to say that thing?
How long? I'm curious now.
Man, I worked on and off. It wasn't like a straight sitting there, but I think on and off for like half a day or so. I kept going back and forth, and then I tried a different way, and I put the bandana on, and I was like, I got to get this right. Come next week, I gotta give him the chicken thing. Shut the FUD up, because I love your phrase so much. So I just wanted to give that one.
Thank you.
Yeah, awesome. Well, you're pumped up now. I'm gonna exit, do your thing. I'll be back.
All right, thanks, Max.
Yep.
Good afternoon, Hexaco. Cairo Copeland here. reinventideal on Twitter, Substack. You also see me on YouTube as well. And I've got some very important things here to share with you. Because as you probably have noticed, well, the crypto market's been having a tantrum now, hasn't it? We got coins plummeting faster than Rachel Zegler's career. And who's the puppet master pulling these strings? One man, Jerome Powell, or as I affectionately call him, J-Pow. The Fed's grim overlord, sitting in his ivory tower and probably cackling as he decides whether to nuke your portfolio, which he can do with a single syllable whenever he speaks. So tomorrow, if you don't know already, it's a very important day because all eyes are going to be on the whole Jackson Hole meeting. That annual banker wank fest where all the suits gather to pontificate about inflation, while the rest of us cling to our Coinbase accounts like rafts. See, Powell's got the market by the throat, and they're begging for a rate cut like it's oxygen. Now, historically, the little powwow they're going to have tomorrow, it's always been a roller coaster for the S&P 500. It has a dip, then it rallies, and then repeats. Like back to 2022, what did it do then? Well, Powell went full hawk in that year, so the market tanked 3% in a day. Just like a suburban princess that's been denied a Land Rover, it throws a tantrum. Or 2023, when inflation was still a gremlin, the market slipped. 2024, he had a very dovish whisper at the time, but that couldn't stop the initial plunge. So, we can expect a dip tomorrow. We might have a big plunge tomorrow, too, because it's like clockwork. Jackson Hole punches, the markets get bruised, but then they get back up. What we are seeing right now is the holy crap, what's the Fed going to do dip? Crypto is basically front-running the chaos, as they so often do. And Bitcoin and Ethereum are trying to play psychic. Why the panic, though? Why is everybody thinking, well, tomorrow's going to be bad? Well, if you hadn't heard about it, the producer price index spiked like a bad fever, so it spooked the markets. They're already jittery from a weakening job market, and Powell is stuck between a rock and a hard place. Basically, he has to choose between getting a punch to the face or a kick to the balls, because the Fed's got a dual mandate. Probably heard him say it a bunch of times. They got to keep inflation under 2%, and then they've got to keep the jobs market alive with full employment. Well, the consumer inflation, CPI, is down, but the PPI is not down. It's out there screaming, surprise! Meanwhile, the job market, what do you think of the job market here? It looks to me like it's wobbling like a Jenga tower. Goldman Sachs says that there will be 3 rate cuts coming before the end of the year, but the prediction markets have slashed the odds of a September cut. It used to be something that was like practically guaranteed. Now it's just maybe. It was at 99%. Then it went down to 80%, and now it's at 70% on the FedWatch tool from the CME. Morgan Stanley even predicts that there will be no rate cuts at all this year. That's a very bold contrarian take, but Polymarket has got it almost 50-50. They're saying a 57% chance of a rate cut now. So, tomorrow, however Powell speaks, if he's hawkish or he's dovish, is going to be widely anticipated. So who's most likely right? The optimists that think a cut is coming, or the naysayers that think nothing is happening until J-Pow goes away? And why does this matter here for crypto? But it matters for crypto here because the thing that makes crypto go up, because of all the bull runs, it's not the halving, because most coins don't even have a halving. What causes it is money printing. And money printing is not going to happen when we have a very strong dollar. And what's keeping the dollar very strong is the fact that interest rates are so high. The 10-year treasury is still above 4%. There is not going to be no bull run until that comes down below 4%. So we desperately need these rates to come down to weaken the dollar so that crypto can go up, because the money printing and the weakening dollar is what causes us to go up. And I'll tell you how that specifically relates to Hex in a moment here. But who's right? Is there going to be a rate cut coming in September, or is it not going to be until December even, or maybe not until next year or until Powell leaves? The Fed July meeting minutes did give us a hint. As here's a direct quote from it. It says, majority of participants judged the upside risk to inflation as the greater of the two risks. And what that means, translation from bullcrap to English, is most officials think stubborn inflation is a bigger threat than job losses. Until jobs really break. They're not going to cut the rates just to please the markets. So why the fear of inflation? Still too high? Core CPI, which excludes food and energy and shows underlying price trends, well, it was 3.1% year over year in July. And remember the FOMC meeting that happened before the most recent CPI and PPI reports? That came in hotter. But PPI is what's keeping it up, because that surged almost a whole 1% in a single month, and the sharpest that we've seen in 3 years. That report came after the Fed met. So even before seeing the spike, the Fed already feared inflation. They see that the inflation risk is greater than a bad jobs market risk. And the new data only confirms whatever bias they already had about that. Now, think of CPI as what you pay at the store, and then PPI is what companies pay behind the scenes before the goods hit the shelves. If producers' costs climb, they usually pass them on to consumers. And that's why a hot PPI print right now can mean higher CPI later, and why the Fed is staying cautious. Not to justify what they're doing, because I don't like what they're doing, but this is just to explain the logic that they're using here. So the meeting minutes say it would not be feasible or appropriate to wait for a complete clarity on the tariffs effects, which in plain English, what that means is the Fed won't wait around for perfect data if inflation looks sticky. They'll keep the policy tight now rather than risk cutting too early. The job market, it's bad, but it's not bad in a way that they notice. Because you see what they're looking at is the unemployment rate, which is at 4.2. The unemployment rate is not a good measure of the jobs situation. It's not a good measure of it all. I like labor force participation a lot better, which is down. It's not looking good. But when we look at, when you look at like how unemployment is measured and collected and everything, it's very flawed methodology. And Jerome Powell knows that. He's not a stupid guy. He might not be our best friend right now, but he's not stupid. Here's the real deal, though. Coming up in September, the Bureau of Labor Statistics is going to issue an annual benchmark revision correcting all the payroll data. And Goldman Sachs expects a large revision saying that somewhere between 500 and 900,000 jobs are going to be removed from measurement. They overestimated almost 1 million jobs added to the economy that are not there. So what I can tell you for sure here is that America is in a recession, and we're at that point where bad news is still good news. So I'm not saying that we should celebrate this or we should jump up and down and be like, yay, America's in a recession. That means we're going to get a cut. But what I am saying is because the job situation is so bad, that is what's going to have to force the Fed's hands to cut. So if I can share my screen here, which I'm going to do over here with this window over here. Let me show you just how bad it really is. Oops, not that screen. Hang on, let me just share this screen. Let's do the entire screen. All right. So here is where we're really at. This is the benchmark revision that they're anticipating coming here. We already had 2 years of bad ones. Already had 2 years of downward revision in 2023 and 2024. We're expecting another bad one here for 2025. But what I think are some more telling numbers on the economy, labor force participation. When we look at this, it still hasn't fully recovered back to where it was before the pandemic. And man, like back in the 90s, those were some good times where we had almost 70% of the country working. We're not even close to that. We're down to 62. We want to look at some more bad statistics here that kind of show how rough it is in the economy. I've showed this one a bunch of times here. This shows that 39 out of 50 states have experienced negative GDP so far this year in the first quarter. But here's a very telling statistic. Look at this. Remember how your parents always told you should go to college because that's going to guarantee that you get a job. It's a first-class ticket to the middle class. I wish I could show them this here. Like if I was a kid, I was 18 years old again, and my parents were trying to force me to go to college, I'd be showing them this. I'd be like, look at this. There is zero difference now between the unemployment rate for college grads and the unemployment rate for high school grads. There's zero reason to go to college now because of this. Look at that. All the hard work you do, all the study and everything. For what? What good does it do you? So this is something that the Fed has to know because this is from their own blog. Yeah, the situation is bad. And how bad is it? This is like the worst statistic I've seen right here. What this one is telling us here, this one shows that the number of young adults that live with a parent. All right? Almost 50% of young adults still live with their parents or one of their parents. And some of this could be, well, maybe they are caretakers here and everything. But still, 50%? Is it got to be that high? This is a giant red flag for the economy. Because what does this mean here? I think you guys that are watching, you boys, you know what this means. Because if you were one of these guys that has to live with your parents, you know what you're not doing? You're not going on dates. If you're not going on dates, well, there's a big chunk of money that the economy's not getting. You're not getting into relationships. You're not getting married. You're not starting families. This is a drag on the economy. Because when you think about it, like, just about everything men do when it comes to the work in their lives, they do for women. When they're living at home, women are out of the question. So a big chunk of the workforce, a big chunk of the economic engine is demoralized and demotivated. The Fed has got to know this here. Does Powell want to continue keep playing politics or continue being Mr. Cauchy tiptoeing around the rates here and everything when you got all these problems? I don't know. We're going to find out tomorrow when he speaks here. But what I can tell you for sure is America is definitely in a recession. And when the Q2 numbers come out in another month, we're probably going to see the same 39 states still in red on that chart, maybe even more. Now, what are they going to do in response to this? I'm thinking it might be the largest cut, the largest rate cut that they've done since the pandemic, probably even since 2008. Because the cut that they're going to make in the jobs data revision is the largest cut since the 2009 financial crisis 15 years ago. Big enough to rewrite the entire story of the U.S. job growth for the past year. And it would mean that the Fed has been looking at this strong jobs market that Powell keeps saying is, oh, so resilient. But it never existed. There never was no resilient jobs market. And this matters because jobs are the only data point left to justify the cuts. In September 2024, the Fed slashed rates by 50 basis points and immediately pointed to labor market weakness as the reason. Inflation wasn't the excuse. Markets weren't the excuse, but the jobs market were the excuse. Want a real sign that America is slowing down? Let me show you this here. This is just like a quick little quick little search I've done here on YouTube. check out these thumbnails here. What do they say is, well, looky here. Influencers are quitting their jobs and going back to 9 to 5. You're telling me that Stacy, the suburban princess, has got to stop her little yoga channel and go back to working an office job. That is a sign that the economy is in serious trouble. Or we take a look at this one here from, what's his face here, Economics Ethan. This one I really like. It says, the job search sucks so bad right now that this woman had to go back to her previous boss and beg to get hired again. That's how bad it is right now. So, the job market is bad enough to justify a rate cut. Whether the Fed wants to acknowledge that or not remains to be seen. But here's what we do know about the Fed is that not everyone agrees. Two Fed governors, Bowman and Waller, they wanted a 25 basis point cut in July. They argued, the tariffs are temporary, the jobs are weakening, we better start easy now, but they were outvoted. So here's the dates you want to pay attention to. Number 1 is tomorrow. Absolutely tomorrow. We want to watch that. Number 2 is going to be my next live stream next week, which I think will be Monday. Number 3, September 5th, we got the August jobs report. And then September 6th, the very next day, we've got the revision where they could possibly erase 1 million jobs, saying, yeah, they didn't really add these million jobs here. They don't really exist. And then, of course, September 16th and 17th, the next Fed meeting. If labor weakens by then, if we got more of these nasty headlines, nasty charts like I've been showing you here, Powell might be forced to cut the rates. Or if we don't have as much of that, he's got enough cover to not make a move, to hold them. But all eyes are kind of shifting to Jackson Hole tomorrow and what Powell is going to say. Now, there's still hope. Still hope in all this here for this year in particular, but a lot of people are thinking that the cycle is going to extend into next year. I am one of them, but I'm not the only one. Alliance Bearstein, which, since they're very bullish, they should probably change their name. They are predicting that Bitcoin will be at 150 to 200,000 next year, and the bull market could stretch all the way out to 2027 as they see it. I don't know that it goes on for that long, but I do think it will go into 2026 just because of how much cutting that they're going to need to do at the Fed and how long it's going to take them to do it. I know that T-Bird out there disagrees with me on it. T-Bird, I'm happy to hear you out. Let's get on a stream. We'll talk it out. But let's talk about ETH and the effect that has on ETH because you see it's all a line of dominoes. First Bitcoin, then ETH. You know that SharpLink, they're hoarding 740,000 ETH like a digital dragon. That's hoarding the gold. Wall Street, well, their ETFs are dumping ETH like it's cursed. BlackRock, Fidelity, ARK. Tens of millions in Ethereum thrashed out. About 2.5 billion in inflows, though, are reminding us that still people want this. But the most important thing for Ethereum coming up is the staking ETF, because that will basically turn Ethereum into a preferred stock. Now, preferred stocks are some of the worst investments in the world for people like you and me, the everyday investor. That's because, one, they really don't get much along the lines of capital appreciation. They trade right along the same price. And two, whatever yields they do pay typically is not keep pace with inflation. And three, those yields aren't even guaranteed, even though investors think they are. But these things are ideal for institutions because institutions get a very special break on preferreds. They get a special tax break on them. I think it's up to 70% of the dividend they get to deduct from their taxes. So it becomes a very attractive thing for an institution to hold because now the yield makes sense for them. It keeps pace with inflation, and the price stays very stable. It trades roughly right around $100 or so. This is good if Ethereum becomes an institutional asset because that's very bullish for something that is a hard fork of Ethereum, because that hard fork is now the more everyday investor-friendly, retail-friendly asset. Because as institutions start using Ethereum and pushing the price up, it's going to become out of reach for a lot of people, kind of like how Bitcoin is out of reach for a lot of people. They could be doing the exact same thing to Ethereum by turning it into basically the crypto version of a preferred stock. But you know who's not afraid of a bear market coming, as evidenced by this? The institutions. BlackRock, Fidelity, ARK Investments. So all you bears out there that say, oh, the cycle's all over, you really ought to contact these institutions and tell them that they should hire you to consult them because in your view, you know better than them and can help them avoid losing billions of dollars. Or how about the firm Amdax? They're out there trying to buy 1% of the Bitcoin supply. That's 210,000 Bitcoin. You got treasury companies that are still gobbling up coins like it's a Black Friday sale. MicroStrategy's probably got a Bitcoin tattoo by now. Altcoin hoarders are scooping up more than just Ethereum. They're scooping up XRP, Solana, like they're Pokemon cards. Bitmine is sitting on 1.5 million ETH, over 1% of the supply. You're telling me it's all over? Coinbase is whispering about an altcoin season in September. Market caps, they say, could go up by 50%. And what they're basing that on is that Bitcoin dominance has slipped from 65% to 58%. And then if the rate cuts happen, that will pour fuel on the fire. Now, if Powell pays hardball tomorrow or the Russia-Ukraine peace talks fizzle, we're going to be waiting longer. But as you know, there are no guarantees, only probabilities. So what does the data say? I got some new data here that I can share with you. The ISM Purchasing Managers Index. And what this is it's a bit of a temperature check, I guess you can call it. A temperature check on the economy. Where did I put that? I think I put it over here. No, I didn't. Yeah, here we go. All right. So if it is above 50%, times are going really good. We got a really nice economy and a really nice markets ahead of us when it's above 50%. When it's below 50%, we got work to do. And when it's below 45%, we're probably in a recession. Right now it's at 48%. So this is like right on the line. And this tells us, well, here's the new orders for producers, manufacturing. This is the raw materials that are being brought into the country. What else do we got going for us here? Take a look at this one. They call this the leading index. Well, what's it leading? Well, it lets us know the indicators, the leading indicators, would let us know whether we're in recession or not. And right now, it is at 98.8 points. What does that mean? What that means is that we're kind of right on the line here. We're still right on the line. This is going to have to make some movement coming up here in the next couple of months here. Whereas back at the ISM, we know we're going to be at the end of the bull run when this thing is probably pushing 60. Or we're going to be at the end of like a good economic times when that's pushing 60. But then, one of my favorite indicators that somebody still wants to argue with me and say that doesn't matter, but he never wants to come on a stream with me to argue with me about it. The dollar index. It's at 98.65. This measures the purchasing power and strength of the U.S. dollar relative to other currencies and to other assets. I say this is most important here because what causes crypto to go up is money printing and weakening dollar bills. Here we got a very strong dollar bill. Now, Morgan Stanley gave us that very bearish prediction earlier that there's not going to be any rate cuts this year. They also have a very bullish prediction that says the greenback, the DXY, is going to drop by 10% by next year. And if that happens, I mean, one, what that shows you is how powerful the rate cuts are going to be the longer that they are delayed. But that is also a gift to risk-on assets, especially Hex and Pulse Chain. Because weak dollar means looser money, and looser money means degens will be piling in to Hex, or basically piling into any kind of centralized finance play, like it's Black Friday at the DEX. It recently had a death cross on the weekly moving averages. I'm not a fan of technical analysis, but the last time that happened, Bitcoin hit a new high 42 weeks later. If we do the math from now, that is going to be May 2026. that aligns with another very crucial economic indicator that you probably have gotten very familiar with. Let's see, am I showing it? Yeah, there we go. Global M2. The M2 money supply. This is another big play here, the M2 money supply, because what this tells us is just how many dollar bills are out there in the world, how much money is in circulation, and it falls in line with I'm not really a big fan of the guy, but Jerome Powell's 2017 on steroids thesis. He's saying that we're going to really experience the 2017 cycle stretched out on steroids. We'll have a weak dollar, more money than ever circulating through the system than ever before. And the global M2 seems to support that. If the DXY comes down, that supports that too. Because you see, global M2, that's basically going to be crypto's mood ring. It's hit a record of 21.9 trillion last month for US M2, and that pushed the global M2 to new highs, and then it tanked. Biggest drop in 7 months. That's a red flag flashing trouble ahead for risk-on assets like Bitcoin or Hex, Pulse Chain. But historically, crypto lags it by 2 to 3 months, which puts late September to early October in the crosshairs for a local top. Not saying that that's going to be the top of the market right there, but might be a good time to take some profits. So what's the play? What's the play here? And what does all this have to do with Hex and Pulse Chain? Here's what we got to say about that. Once this starts to get going, which could be September, Coinbase seems to think so, Goldman Sachs seems to think so, the institutions seem to think so. The only namesayer really is Morgan Stanley. Once it starts to get going, you want to be prepared already. You want to be buying right now. You don't want to be waiting until September or until the thing gets going to buy. Obviously, you want to buy it when it's cheap, because what you're going to experience is a lot of FOMO. Now, here's what's going to happen. I guarantee you this is going to happen to you here. You're going to buy, and then Powell is going to come out and say something to make your coins go down. That is a test of your conviction. Markets test your conviction with time, not just the price. Smart investors are going to be stacking up for the long haul, but pocket the cash at the local tops. You just got to ignore the FOMO. And then you also got to ignore the headwinds that are coming down at it. Because I guarantee you, right after you buy, the price is going to go down. Happens there to me every time. But here's the reason for the ultimate conviction. Because you keep hearing the crypto media go on about Bitcoin supply shock and how there's so little of it on exchange. Do you know what has an even smaller supply? Let me show you what has an even smaller supply. Where did I put it? There we go. So check this out here. For the liquidity on Hex. This is just eHex right here that I'm looking at. See, the 351 million, I think that's referring, well, that's not referring to eHex, that's pHex that's referring to. 351 million. That's less than $4 million worth of liquidity. We know that money printing is what causes the crypto market as a whole to go up. But what causes one coin to go up more than the other coins? That is low liquidity. And right now, Hex has got the lowest liquidity out of all the coins out there. That's, aren't obvious scams and rugs. But the best part of all this here is that we don't even need anybody to bridge the Pulse chain and buy Hex. We don't even need anybody to buy it on Ethereum. We just need the DXY to weaken, which will power up Ethereum. And because of liquidity pairing, our price gets pushed up. So, why Hex? I haven't said much about it, despite it being a Hex Week speech, but it's because money printing is what makes all coins go up. But what makes the coin go up the most is the low liquidity. You want to think about it like this. Say we got a nightclub. And, if you're managing a nightclub, you ought to know that what makes it go, what makes it popular, is having a lot of hot girls there. But suppose you couldn't get that many of them. Suppose you could only get 10 hot girls. But there's 100 guys wanting to come in. Well, those 100 guys represents dollar bills. Those 10 hot girls represents Hex. It's just not enough to go around. So these 100 guys are going to be raising their prices, saying, I'm willing to pay this, I'm willing to pay that, blah, 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 blah. And these girls are going to be pushing up their prices, saying, you better be willing to pay this, you better be willing to pay that because I'm worth it. And it's just going to be this God candle that rips right through like a giant middle finger to all the bears out there that's consequently chickened out of ever streaming with me. And that's what I've got for today here. So my name is Cairo Copeland. My channel is reinventideal. Find me on Twitter at reinventideal. And check out my weekly streams, my Substack, everything. I will kill the inner bear within you.
I love it, man. You are one of the funnest people to watch and most informative in the ecosystem to this point. I'm so glad you started streaming and sharing content, and so I got on Spaces the other day and everything else. So thank you very much for Hex Weekend with making it hexy, getting hexy.
It's my pleasure, yes. And don't forget, Hexagon University, Tuesdays at 7 p.m. East Coast time.
Awesome. Well, appreciate it, man. Hop back on for the Hex panel later if you're interested. Feel free. It's open to everyone, but no worries either way.
All right, Max. I'll see if I can make that for you.
Awesome. Thanks, Cairo. See ya.
My pleasure.